It's time to reboot your credit card with Apple Card. Apple Card is a different kind of credit card. It gives you up to 3% unlimited cash back on everything you buy. It's real cash that never expires or loses value. And you can use it on anything. Grab a morning coffee, pick up a tab, or pay back a friend. Apply now in the Wallet app on iPhone and start using it right away. Apple Card issued by Goldman Sachs Bank USA, Salt Lake City branch, subject to credit approval. Daily cash is available via Apple Cash Card issued by Green Dot Bank, member FDIC, or as a statement credit. Terms apply. This episode is brought to you by Schwab. Do you ever think about your money? I'm sure you do. You probably think about it all the time. But guess what? Your money's been thinking about you too. And it wants you to know that a financial plan can lead to 2.7 times higher net worth on average. That's why Schwab makes starting one easier than ever with one-on-one guidance from a financial consultant and a complimentary online retirement plan that you can start in as little as 15 minutes. Plus, track your progress with free digital planning tools. So, what are you waiting for? Visit schwab.com/plan today to learn more.
Hello and welcome to the Too Big to Fail, Too Furious episode of Slate Money, your guide to the business and finance news of a week in which we had another major bank fiasco. I do apologize. And when I say I mean Felix Salmon Abaxios. That is me. I'm here with Emily Peck Abaxios.
Hello.
I'm here with Elizabeth Spires.
Hello.
And yes, I apologize for a third week in a row of talking about banking, but I promise it's the last. No more banking next week. This week we talk about Credit Suisse and UBS. Next week we talk about work from home or something like that. We'll just do something completely different. We are also going to talk about deposit insurance, which you probably care about. I don't know. We're going to persuade you that it's important, and the politics thereof. And we're going to talk about TikTok and the politics thereof. And we're going to talk about Rupert Murdoch in the Slate Plus segment. And then we're going to have a Slate Money Succession podcast on Monday. It's all very exciting, but keep on listening to Slate Money. So guys, we had a major upheaval in the world of global banking this week, which I feel like we've now had 3 weeks in a row where we're leading with banking, which is a bit much. And apologies to those of you who aren't as interested in banks as I am, but, you know, I did start my career at Euromoney magazine, which is all about banks. And this is just amazing to me that Switzerland now has basically one big bank. When I was a cub reporter, it was relatively normal. It had three. It had SBC and UBS and Credit Suisse. And now, long after SBC and UBS merged, Credit Suisse has failed into the arms of UBS in a shotgun marriage that was engineered by the Swiss regulators and that shareholders had no say in. And there is now one bank in Switzerland, and a lot of Credit Suisse investment bankers are sort of dazed and confused and thinking they're probably going to be out of a job soon. Emily, this is a big deal, no?
Felix, I guess it is a big deal. Clearly, one of the biggest banks in the world has failed and been forced to marry or been absorbed by another really big bank. But I have failed to become engaged with this big banking story, despite your obvious enthusiasm for this big bank story. I have, on my notes for the show, I wrote a question, which is, Felix, why should Americans care about this story? And I want you to make me care, and the listeners, and Elizabeth too. Maybe Elizabeth already cares. She can
Elizabeth,
say
you care
about
right?
this story.
I care a little bit. I don't find, the news surprising at all. To me, it's just a miracle that Credit Suisse didn't collapse before this. It's, it's had scandals and problems for probably a decade now. But I do think it's important in the sense that it affects the global banking system, which is going to have blowback for the U.S. However, I might be a little burned out on banking, global markets are reacting to the news, and I think it's not clear whether the move has really shored up confidence in the banking system at large, because it's not clear that people are really differentiating between Credit Suisse's situation and some of the other problems in the banking sector. I think a lot of people are just conflating them all.
Yes, that's true. This we are recording on Friday morning, and there's a lot of reports that Deutsche Bank now is kind of its share price is falling. Felix hates that metric. I'm sure he'll explain why. And people are now worried about Deutsche Bank, which again, I'm like, oh, another European bank I'm going to have to figure out why I care about. So back to you.
The first thing to say is that, when a too big to fail bank, a GSIB, as it's known, a global systemically important bank, has to be rescued by the government and or intervened and or sold in a flat fire sale to a rival, that's a big deal, right? There are only 30 of these institutions in the world. One of them has just effectively failed. Another one, Deutsche Bank, which I guess, like, if anyone had to put up a list of the two banks the two GSIBs most likely to fail, it would be Credit Suisse and Deutsche Bank. Is now feeling the heat, and it kind of stands to reason, right? A couple of things going on here. First is that because these banks are too big to fail, and because we lived through the financial crisis of 2008, we understand that these banks need to be regulated much more assiduously, and they need to adhere to much higher standards in terms of capital and bank regulation and stuff like that. And in fact, there is even a conversation in the US right now that part of the reason why Silicon Valley Bank failed was because it had managed to get out of those enhanced oversight standards because it wasn't too big to fail. It was small enough to fail. But people are saying maybe it wouldn't have failed if it had been held to these higher standards. And so now with Credit Suisse, everyone is quite reasonably saying this is a regulatory failure on the part of the Swiss authorities. They should never have let Credit Suisse get to this terrible position. And so what they're basically then just to follow the next shoe to drop would be the German authorities, right? Looking after Deutsche Bank, which has had, a basically zero share price for a long time now. No one really thinks it's an inherently profitable bank that is going to make lots of money for shareholders. It's a very important bank. But the shareholders don't seem to have a lot of, residual claims on it. And so they're saying, well, the regulators might force something a bit like the Swiss regulators did. They might force it to raise more capital. They might raise down some of those cocoa bonds that, got written down in the Swiss case, or so on and so forth to strengthen Deutsche Bank. And if they were to do so, that would naturally be bad for the share price. So that explains why the shares are down. It would also probably be bad for certain types of debt instruments. So that explains why the credit default swaps are up. And, the idea is that I think of a bank like a car, right? Cars have become a lot safer over the years because we've built in protection protocols, right? You have crumple zones, you have airbags, you have things that explode, which keep you safer, right? And that we're keeping safe here is the depositors, basically, the people at the center of the bank who can't afford to lose money. And then around them is this whole edifice of AT1s and equity and stuff like that, crumple zones that can absorb a bunch of hits to keep depositors safe. And when you run into a banking crisis, and we are in a banking crisis right now, not a particularly bad one, but we are in a banking crisis, those crumple zones and airbags and things are designed to take hits. And what we're looking at when we look at the market, whether it's in AT1s or credit default swaps or share prices or anything else, is the market working as intended and as regulators intended, which is those things taking hits and the depositors being safe. Like what we didn't have in Switzerland, in the case of Credit Suisse, was a bank run, right? You didn't have Credit Suisse depositors, or not very many of them anyway, worried that they would lose their deposits and taking their money to UBS instead. So yeah, I feel like this is the bank system working. But yeah, if we go from 30 GSIBs to 29, if we go from 3 Swiss banks to 1, if Credit Suisse, which remember is a major investment bank as well as just a wealth management platform, basically ceases to exist, along with all of its grand plans to spinning off First Boston and all of that kind of stuff, that's a major recalibration of the international financial architecture, and it's worth thinking about and caring about.
Because it's a major recalibration of the financial architecture. But what is it?
I think let me just try and make one more attempt to persuade you that this matters. What this shows, and I think why Americans should care, is that we now have the tools to do this, right?
That's good.
That like Basel III and the regulatory architecture that sprang up after 2008 gave the Swiss National Bank and FINRA, which is the financial regulatory authority in Switzerland, the ability to just go in and solve this problem. What Switzerland didn't have was a Lehman moment, right? What Switzerland didn't have was a major bank just declaring bankruptcy and all hell breaking loose. It was rushed, it was slightly chaotic, various people were unhappy for various reasons, but what we had was a situation where everyone who mattered, which is like the depositors and various, senior bondholders and interbank loans and that kind of stuff, repo transactions, like all of those people, all of the bank counterparties, like if you bought a structured product from Credit Suisse where like it pays you the rate of return on the stock market, but it caps your downside, so you can't lose more than 10%. And the reason it does that is because it caps your upside at so many other percent, whatever. One of these things that wealth management clients buy all the time. You are not worried about counterparty risk, right? It could be the case that, like, if the stock market falls, Credit Suisse owes you a bunch of money, and that kind of obligation of Credit Suisse is 100% fine, right? No one reached the point of being worried about Credit Suisse counterparty risk because we now have the ability to rescue banks or to merge them into other banks or to send the COCOs down to zero in a way that protects all of the people that we need to protect.
Yeah, but
you have just explained why I'm bored by this story. Because it is a story of things working, and I am a journalist, and I'm inherently less interested in things working than things not working. So that may be why I'm less interested in this story.
Though things could have been in a position where they didn't work because there wasn't a bank run, but there were $147 million worth of deposits that were pulled out of the bank in the last quarter, and without the Swiss government kind of forcing this merger. I mean, I don't see anything that would have necessarily prevented a bank run in a panicky moment.
So, no, I mean, the forcing the merger is the solution, right? That's the whole point. Yeah, Credit Suisse, left to its own devices, was spiraling downwards in a very unsustainable way. And so regulators need a way to resolve those kind of situations. And what we have just learned is they have a way to resolve those situations. And they can do things like writing the AT1s down to zero. And they can do things like change the law to prevent shareholder votes. And they can do things just like forcing UBS to buy Credit Suisse, whether they like it or not. And all of these things are things that they had to do in order to prevent something bad. You're absolutely right that it could have been bad if they hadn't done that. My point is that we now know that we have the tools to prevent it being bad and that regulators are willing and able to use those tools.
Yeah, I guess I'm just I'm thinking about your contention that banking is categorically safer now. There was a good opinion piece in Bloomberg, I think this morning or this week, arguing that a lot of what we're dealing with has to do with the total dismantling of Glass-Steagall, which happened quite a while ago, but created a lot of the too big to fail banks. So that now
that's crap.
Okay. All right.
I mean, hang on a sec. Even Emily is shaking her head at that one. But Glass-Steagall is an American law. That has nothing to do with Switzerland. Credit Suisse didn't even have a commercial bank in the US.
Are we
Like,
talking
come
about the
on.
overall banking system, and how many of the G-SIBs are American banks? Okay, I'm taking it for granted that
7?
this
12,
isn't a
I think.
global problem if a bunch of banks fail in the U.S. or in Europe.
Sure,
Like,
but
would you argue
the
that
number of
the Credit Suisse failure is completely unrelated to banking problems in the American banking sector, and it's just
I don't
coincidence?
think there are banking problems in the American banking sector. I think the American banking sector, at least if we're looking at the G-SIBs, the
Yeah.
American banking sector is fine. The American G-SIBs have all seen deposit inflows rather than outflows, right?
That is the story I wrote this week, in which I said that too big to fail is good now.
Yeah, too big to fail so long as you have the tools to prevent, a catastrophic bank failure, then too big to fail is good in terms of bank failure, right? The problem with too big to
Right.
fail was bad because if you have a bank like Lehman Brothers that was too big to fail and then it failed, then you cause a financial crisis. If you have a bank
Correct.
like Credit Suisse, which is too big to fail and then it fails and then you have the tools to resolve it, that's fine.
Right. They fixed the to fail part by strengthening regulations after the financial crisis with Dodd-Frank in the US. I don't know about credit. I don't know about Switzerland as much as Felix does. But they tightened up regulations. So at least for our too big to fail or our G-SIBs face tighter regulations and for now appear to be safer places for people to put their money, precisely because Americans know that they're not going to be allowed to fail in such a way to blow things up.
And then I'd also add, in terms of Glass-Steagall, that however many American institutions there are on the list, Emily's probably done the counting up more than I have. There are really only 3 that include both a commercial bank and an investment bank, right? It's Bank of America, Citibank, and JP Morgan. And so all of the rest of them are either sort of one or the other. You don't and plus it's, even if you even if you forced them to break up, right? Even if you forced Bank of America, JP Morgan, and Citibank to break off their investment banking arms from their commercial banking arms, all 3 of those commercial banking arms would still be too big to fail. And probably the investment banking arms would be as well.
That's the thing I was thinking about after I wrote this story this week is maybe you fix the to fail part in that there's all these laws and regulations to ensure that if a bank is tottering, its dissolution is handled in a way that doesn't blow up the economy. But the too big part remains. We have these gigantic banks that are basically quasi nationalized institutions. That's the choice we made. Instead of breaking up and having smaller ones that could explode without blowing up everything, we decided to have big ones that we kind of make sure they're ring fenced and regulated and have to adhere to rules. And I don't know if that's better or not. Is it better to have just a few big banks that you feel safe?
Yeah, we talked about this a little bit last week, Emily, which is that there isn't a country on planet Earth which has a lot of small enough to fail banks that work. In some kind of weird utopia, perhaps that works, but in practice, it doesn't exist. And then on top of that, the fact is that when you have thousands of small enough to fail banks, that system is fine when one bank fails. But the thing that causes one bank to fail is the thing that causes 1,000 banks to fail. And when you have 1,000 banks failing, then you have the S&L crisis of the 1980s, and that's just as bad. That's just as systemic, right? That any one bank might be small enough to fail, but collectively, if they all do the same thing at the same time, and banks are herd animals just like venture capitalists, then you still wind up with a system of interconnected banks that are collectively too big to fail.
Okay. Maybe my follow-on thought, which maybe I already talked about last week, you'll tell me if I did, but if we have these we've decided it's good to have these too big to fail banks as long as they're regulated well and blah, blah, blah. It's good. But they're quasi-nationalized. So why do the executives at these banks get to make $1 bajillion? If they're not really private companies, right? I mean, they would say they are, but clearly, like, they're very dependent on the United States and the federal government and regulation and all of the state support. Like, why do we pretend these are private companies and treat their executives the way they're treated? It doesn't make sense to me, really. Investment banks, to go back to Elizabeth and Glass-Steagall, like, why do they get to do like I thought a bank is a public good. Like, this is what they taught me in elementary school. It takes my money and it lends it to the farmers and it lends it to people building offices and shopping malls and businesses, small business owners. No one taught me, like, banks are a public good. They create these interesting instruments that really rich people buy to help them make money, and the federal government's backstopping that. Like, what? Why is that a public good? Like, let the wealthy people figure out another way.
Well, the wealthy people have figured out another way, right? And it's called investment banking and capital markets. Mm-hmm. And there is this natural economy of scale, you could call it, or just like, if you're a big company, then at some point you start graduating from issuing loans to issuing bonds, right? From borrowing money to the bank to issuing a bond. And there's a lot of reason why your banker, the person who understands your business and who has been banking you, why you would want that person to understand both the bond market and the loan market so that they can offer you both products and you can choose intelligently between the two. Like, it does make sense for the commercial bank and the investment bank to be the same person in that sense, right? And as we said, like, it doesn't help in terms of too big to fail if you split off the investment banks, right? Goldman Sachs is an investment bank. It has, I guess it has like Marcus or whatever, but if it spins it off, it's basically an investment bank. And it's too big to fail. There are lots of investment banks that are too big to fail. Like, just being an investment bank doesn't mean you're small enough to fail. So Morgan Stanley is a huge investment bank that is too big to fail. So the point is that what we are doing is precisely what you said, which is that we are telling these too big to fail banks that the government is basically giving them a subsidy in terms of this relatively explicit statement that they will be there for them in case of emergency. And that is a valuable subsidy that is worth money to them. And therefore, if you are one of these banks, if you're one of these GSIBs, then what you need to do is pay what's known as a GSIB surcharge. You need to basically give the government more money. You need to keep much more, have higher capital reserves. It is more expensive, significantly more expensive, to be a too big to fail bank than it is to be a small enough to fail bank. And so the government is sort of effectively taxing too big to fail precisely for that reason that you were talking about, because they have that implicit subsidy.
Yeah, but to Emily's point, the SVB situation is a good example of where, the GSIBs pay into this for some amount of insurance, and then the government decides that the ceiling on deposit insurance should be higher, and so they say, okay, in this case, we're just going to guarantee everything. If the deposit ceiling goes away, we have universal deposits, which is on the table now somewhat. Is there an argument for having the GSIBs pay a lot more than they're already paying in order to kind of cover that cost?
Let's have a quick break and then talk about deposit insurance, because that's a whole other question.
It's time to reboot your credit card with Apple Card. Apple Card is a different kind of credit card. It gives you up to 3% unlimited cash back on everything you buy. It's real cash that never expires or loses value. And you can use it on anything. Grab a morning coffee, pick up a tab, or pay back a friend. Apply now in the Wallet app on iPhone and start using it right away. Apple Card issued by Goldman Sachs Bank USA, Salt Lake City branch, subject to credit approval. Daily cash is available via Apple Cash Card issued by Green Dot Bank, member FDIC, or as a statement credit. Terms apply. This episode is brought to you by Charles Schwab. Schwab's passion for serving clients is more than standard practice. It's part of who they are. With transparent pricing, 24/7 live support, and a satisfaction guarantee, the people at Schwab go the extra mile to help you on your investing journey. They're not just financial people, they're people too. Learn more at schwab.com/whyschwab.
That was the sound of another sale on Shopify, which is the easiest platform out there for selling stuff on the internet. It could be fine art prints. It could be succulents. It doesn't matter. Shopify simplifies selling online and in person so that you can focus on growing your business rather than the nuts and bolts of how to sell stuff. Shopify is packed with industry-leading tools, and thanks to 24/7 help and an expensive business course library, it is there to support your success every step of the way. Sign up for a $1 per month trial period at shopify.com/money, all lowercase. Go to shopify.com/money to take your business to the next level today. Shopify.com/money. Okay, so Elizabeth, deposit insurance. Explain to me why you think it's the G-SIBs that should pay more, because clearly it wasn't the G-SIBs who had the highest percentage of uninsured deposits, right? It was people like Silicon Valley Bank and Signature Bank and First Republic Bank.
I think if we end up with universal deposit insurance, that everyone should probably pay more, not just the G-SIBs.
Right. I mean, that's clearly. That goes without saying. I think, right? That the deposit insurance is you have to pay an insurance premium to the FDIC. That insurance premium is levied on all of your insured deposits. So right now, it's levied on the deposits that you have under $250,000. If they literally took the ceiling away and by law changed that to unlimited deposit insurance, then that deposit premium would be levied on all deposits. And then to the extent that you had large quantities of uninsured deposits, you would be paying a premium on those as well. That's how deposit insurance works.
Let's back up and talk about, just lay the ground for why we're talking about deposit insurance. So maybe listeners know at this point, but feels worth kind of recapping the situation, right? A little bit?
Go for it.
Okay, so Silicon Valley Bank has failed. About 90% of its deposits were uninsured, meaning they were above the limit for FDIC insurance, which is $250,000. Pretty unusual for the proportion of uninsured deposits to be that high. And anyway, it failed. And one of the problems was, oh my God, are all these uninsured depositors going to lose all their money? And Treasury and the White House and the FDIC decided, no, we're going to make everyone whole. We're going to make it all right. So then it's sort of opened this basically huge can of worms for everyone in the country, and has become this really weird issue, basically. Last week, Janet Yellen was at the Senate, and a senator from Oklahoma was just like, if my local community bank, went under the way Silicon Valley Bank went under, would you step in and make uninsured depositors whole? And she basically said no, and that kind of went viral. And then she has spoken about this now, I think, two or three more times.
Let me jump in here, Emily. She did not say no. She did not say no.
She didn't say yes. She didn't say yes,
but she didn't say no. Yeah.
Right.
She has been strongly implying yes. What the Federal Reserve
strongly implying yes, as we all know, is not the same thing as saying yes.
Yes, but it's clearly
Ask
not the
me
same
if
thing
I
as
want to
saying
meet
no.
for lunch later. Maybe.
So
I'm
like,
not saying no.
I was with you all the way until when you said she said no, because she didn't say no. She strongly
She
implied yes.
didn't go as far as say no. Yeah, she didn't go as far as to say no. But I think because she didn't go as far as to say yes, it really didn't make the issue any better, and has spent now this previous week basically trying to walk the same line where she says deposits are secure, but she doesn't say uninsured deposits are secure. And it's taken this like part of banking, I think, that no one was really thinking about that much before, and has made it an issue that is in need of resolving. And now there's all this talk about raising the limit, like Elizabeth said, or getting rid of the limit.
Yeah,
So
I think there's, there are also some in-betweens in terms of, the status quo and completely universal insurance, including
yeah, just raising it a little bit more.
Raising it more, but also including different provisions for businesses, for example, which will have different constraints because they have payrolls to make. But yeah, that's what do we think is likely to happen? And if they do just raise the ceiling, how is that determined? Because the last time they did that was 2008. And I think it's widely agreed that the 250K cap is somewhat arbitrary. So where would they land?
Any cap is arbitrary, right?
Well, presumably there's some kind of, policy analysis that goes into that. I don't think it's totally finger in the air.
It's actually kind of weird that, hasn't been adjusted for inflation or anything. So I think if it had been, it would already be at like 320 or something like that.
Yeah.
It's kind of weird that it just stays where it stays. But every time it's been raised in modern history, it's because some crisis is afoot. It was raised during savings and loan crisis, and then it was raised again in 2008. And I don't know if this counts as a crisis right now. Do you guys think?
So I need to jump in here. The first thing is that it's not going to get raised. It wouldn't help, right? If you raised it from $250,000 to $400,000, then the percentage of uninsured deposits at any bank you care to mention would not meaningfully change. Silicon Valley Bank would still have been 90+% uninsured. With what we're talking about is corporate transaction accounts with, $10, $50 million in them, then fiddling around with the deposit insurance rate and moving it up from 250,000 to, whatever it would be, like even 500,000, wouldn't make any difference. So they're not going to do that because it's a solution in search of a problem. The problem was never individuals with $300,000 in their account who are worried about that extra marginal $50,000. Like, that is not the issue facing America right now. So, yeah, it's not going to get raised. Raising it wouldn't help. Let's just move that off the table.
Wait, I'm going to push back a little to my...
Okay.
I already regret doing this. But it's not about will the percentage of uninsured depositors at the banks change if the cap is raised. It's about sending the message that we're doing something about this that's real, instead of making statements that are neither no nor yes.
Sure.
It's just
right.
it's a message meant to ensure trust. And that's the problem.
Right.
Trust.
Right. Absolutely. But my point is that if you want to send a message that you're doing something real, then fiddling around with the deposit cap and moving it from one six-figure sum to another six-figure sum is not going to send that message, because in fact, it's going to be worse, right? In fact, it would send a bad message and all of the bank stocks would fall. Because if you raise the deposit cap tomorrow from 250,000 to 400,000, say, right? That is, at that point, a very clear message that all deposits over 400,000 are not insured. Right now, we have a pretty clear message that deposits over 250,000 are insured. They're just not quite coming up and saying so explicitly, but they're definitely saying so implicitly. If you raised it to 400K, then that would send a message that deposits over 400K were not insured, which would be worse.
Yeah, we should also mention that there's another option on the table where the deposit insurance doesn't get raised, but there are some congressional officials are talking about using the Exchange Stabilization Fund, which is controlled by the Treasury Department, and it's used to kind of buy and sell currencies, but has also been used to backstop in emergency situations. So there's a way to kind of potentially repurpose that so that you can temporarily authorize an increase or remove the cap on deposits, but it's not a permanent thing.
So they actually already did use the Exchange Stabilization Fund to backstop the Fed liquidity discount window, right? Basically, what happened on the Sunday after Silicon Valley Bank failed was that they did two things. One was that they insured all of the deposits of Silicon Valley Bank and Signature Bank. That was a very clear signal that the FDIC was willing and able to insure all uninsured deposits. That there is no rule, by the way, that the FDIC is only allowed to insure the first $250,000 of deposits, right? If you go into your bank and you see the sign saying like FD with the big like brass sign saying FDIC on it, what it says in very, very clear letters was all deposits insured to at least $250,000. $250,000 has always been the minimum that deposits are insured to. It has never been a maximum. So the FDIC is always capable of insuring more. And as we saw in the cases of SVB and Signature Bank, they can absolutely and did insure everything. And they can do that with any bank that fails anytime they want. And they can do that very easily just by saying, we're worried about contagion and there's a systemic something, and bang, they can do the whole thing. And it is basically certain, if you listen to what Yellen and Powell have been saying over the past couple of weeks, that any bank that fails in the next, few months will be treated exactly the same way. There is no way they are going to let another bank just set off another panic. They will insure everyone. So that is the message that they have been sending. They just haven't said that explicitly. And it's worries me that they haven't
getting out there.
It's not the message that's getting out there because they haven't said it explicitly. And so for me, the obvious thing to do, which is free, which doesn't cost anybody anything and doesn't need any kind of legislation and doesn't need to use the Exchange Stabilization Fund, doesn't need to do anything, is to just come out and say, look, for the time being, because we're in a bank crisis, any bank failure, any loss of uninsured deposits would have systemic consequences. Therefore, the FDIC is going to insure everything for the time being. Like they can do that. They can say that. I don't understand why they haven't said that. And like the guy from The Economist asked Jay Powell this at the press conference on Wednesday. He was like, look, are you saying that like we have a de facto unlimited deposit guarantee for the time being? And Powell was very careful. He says, well, I'm not saying anything more than I'm saying. And he's like choosing his words very carefully. And then Yellen comes up in Congress and they're like, are you thinking about insuring all deposits? And she's like, no, we haven't talked about that. It's like, I don't understand why they're being so cautious about just saying, look, we're in a bank crisis. We're fine. Everything's fine right now. They're strongly implying it. There's clearly sending that signal to the message, that message to the markets. But, as you say, Emily, quite correctly, that message is not getting through to depositors. But Elizabeth, to your question, yes, they used the ESF to backstop the discount window. Like what's happened is that the Fed has said that if you have any kind of bank run, any deposit run, and you need liquidity, you can borrow that from the Fed. And they will lend against your bonds at par, at face value, not at market value. And that theoretically opens up the Fed to the risk of loss if the bank goes bust and they have to foreclose on the bonds and then they have to sell the bonds at a loss. And in that rather remote possibility of loss, then the Exchange Stabilization Fund is there to sort of guarantee the Fed's losses on that. So they've already used the ESF to try and prevent bank runs.
Yeah, I wonder if some of the hesitancy to just come right out and say this is simply political, because there is a huge Freedom Caucus, backlash against the idea of increasing deposits or anything that might be even an equivalent of a universal guarantee. And so they may just be trying to avoid politicization of it. But I agree that I think it's, undermines what they're trying to do. they're not
Just
communicating
say it, Janet
effectively.
Yellen. Just say
Yeah,
it.
I don't. I'm not even honestly. I'm not even seeing this as a left-right issue. Like, I don't think that we have a situation here where like the left wing wants unlimited deposit insurance and the right wing is worried about moral hazard. Like,
Yeah, no,
there are
it's definitely
definitely
it's a minority right wing constituency. They just happen to be very vocal and are led by Josh Hawley. So
yeah. I don't think that Janet Yellen is being coy because she's worried about upsetting Josh Hawley.
I feel like she's being, well, I don't know. I can't speculate why they're not just saying what needs to be said.
My theory is that my theory is twofold, right? One is the Yellen and Powell. Well, Powell is absolutely unelected. Yellen is part of the democratically elected Biden administration. Like when she moved from the Fed to Treasury, she basically became a politician. But she's the most technocratic form of politician. She doesn't feel like she's a politician, right? And what technocrats do when they're being asked to sort of make policy on the fly is they always try and let the politicians make that decision rather than, making it themselves. And so my gut feeling here is that Yellen and Powell are really punting to Biden on this. And what I wrote in Axios Markets this weekend is basically that what we need to solve this problem is not a clearer statement from Janet Yellen. It's not a clearer statement from Jay Powell. It's a clearer statement from Joe Biden. That Joe Biden should be coming out as the communicator in chief and saying, hey guys, your deposits are safe. If any bank fails, we will make sure that uninsured deposits are safe. If Joe Biden came out and said that, then both Yellen and Powell would be much more comfortable saying that explicitly. Plus, we would be getting it from, the man himself. And I do not understand why neither Biden nor Harris has said anything about this.
well, there would be a knee-jerk backlash on the right, especially from our existing Republican presidential candidates, to find a reason to oppose it, because at this point, electoral politics is so driven by negative partisanship that
Right, but
there are Republicans who would normally agree with it.
Everything that Biden says is opposed by the right. Like you can't like run your presidency on the basis of I can't say anything because my opponents will disagree with me.
I say that to Democrats all the time. I'm just telling you what I think the calculus might be there.
But explain that calculus. So Biden comes out and says something clear about deposits. Trump or DeSantis or someone like that comes out and says, this is terrible, this is socialism, they do whatever they do.
Yeah, they would say
Why
that it was
is
a
that
doorway
bad?
to bailouts.
Sure.
They would
fine.
make an argument, and also because this is not an issue that the average person really understands. But they do know there's
Right.
Average person backlash against bailing out big wealthy institutions, and that's how this would be positioned by the Republican right. Even though there's not among moderates.
No.
People,
I 100%.
Yeah.
I agree that you would get this position. You would get like DeSantis or something saying bailout, right? And so that we posit that. Explain to me why that is bad for Biden.
Because there's a constituency of Democratic leadership who believes that Democrats only win when they're able to convince moderate Republicans to switch parties. And they're very powerful, and, Democratic leadership listens to them. There's a huge constituency of donors who believe
and you're
that.
saying that the moderate Republicans would like turn on Biden because they would think that like his safety and soundness regime for the banking sector was socialist bailout. I don't know. Anyway, the whole thing seems ludicrous to me, and I think that we need.
I'm not saying I buy. I'm not saying
Emily,
I buy the logic. I'm just telling you what I think it is.
I think this is an interesting issue though for the politics, because like that exchange I was talking about with Janet Yellen at the Senate, that was with a Republican from Oklahoma who was like, it's not fair if you bail out the uninsured depositors at this one bank if you don't bail them out at my Oklahoma bank. So I feel like the space around like local, regional, small banks is sort of politically could be different because so many of these lawmakers, you know, come from places with like small local banks that are donors or whatever, and they might have a different perspective if it's
I agree. I think
framed
if
as like
you come out and say your regional banks in Oklahoma are safe, you know, I feel like your moderate Republicans in Oklahoma are going to like that. But I am not an expert on politics.
I don't know.
But I do
Elizabeth's
actually want to stick on the question of politics because we have a super interesting political question in Congress this week about TikTok. So that's coming up next.
Support for this podcast comes from Wise, the universal account that lets you send, spend, and receive money internationally. With one account for over 50 currencies, who exactly is Wise made for? It's made for jet setters and slow travelers, for seeing old friends in new places. Wise is made for business in the city and pleasure on the coast, for studying abroad and supporting your little brother's schooling back home. Wise is made for people without borders who want to live truly global lives with ease. You see, with Wise, you always get the mid-market exchange rate whenever you convert or spend different currencies. There are no markups and no hidden fees. That's pounds to pesos, dollars to dong, just like that. Helping you save on currency conversion wherever your money takes you. Wise. It's the account that's made for the world. Join 13 million customers and learn how the Wise account could work for you at wise.com/slatemoney.
This episode of Slate Money is sponsored by Progressive Insurance. Most of you are multitasking right now. That's what people do when they listen to podcasts. You're cooking, you're cleaning, you're driving your car, you might be grocery shopping. What you could also be doing, at least if you're not driving a car, maybe if you're in the passenger seat, is getting an auto quote from Progressive Insurance. Drivers who save by switching to Progressive save nearly $700 on average, and auto customers qualify for an average of 7 discounts, like maybe because you're a homeowner or because you have multiple vehicles on your policy. Multitask right now. Quote your car insurance at progressive.com to join the over 29 million drivers who trust Progressive. Progressive Casualty Insurance Company and affiliates, national average 12-month savings of $698 by new customers surveyed who saved with Progressive between June 2021 and May 2022. Potential savings will vary. Discounts not available in all states and situations. Okay, so I love this TikTok thing. And the TikTok thing, just to be clear, is the CEO of TikTok coming up in front of Congress and being grilled by a bunch of very ornery politicians on both sides of the aisle. And one of the reasons I love it is because it is one of the areas where you have genuine bipartisan agreement. Republicans and Democrats seem to both be in agreement that TikTok is bad and should probably be banned or be sold or something, China something. And normally, when you have strong bipartisan agreement on this kind of thing, it is pretty obvious that politicians, because they literally make the law, get what they want. And what is fascinating to me is that the politicians who literally make the law and who are in agreement on this TikTok thing, there's a very good chance they are not going to get what they want and that TikTok is going to remain a Chinese company. And so, Elizabeth, explain to me what is going on here.
So the TikTok CEO is in front of Congress this week to defend the company against allegations that the software is being used to spy on Americans, that TikTok is, not healthy for children and teenagers, that its algorithms, make kids depressed. I mean, a whole range of concerns. The most legitimate of one, in my view, is just the the surveillance aspect of it. TikTok does present, I think, a real security risk, and that's where part of this bipartisan support is coming from, is a sort of general distrust of China. One thing that struck me watching some of the hearings, though, if you've watched congressional hearings with regard to anything that is about technology, you often find that the elected officials don't really understand the tech. And there was a little bit of that happening. There were two Congress people who referred to TikTok as Tic Tac repeatedly. And so a lot of them don't necessarily even understand the cybersecurity implications. They just know that we have a cybersecurity threat from China, and TikTok seems like one of the most prominent available vectors because it's so heavily used in America. I think there are 150 Americans on TikTok.
Million.
Right.
Sorry. Yeah, 150 million.
Yeah, it's more than 150. I can.
Yes.
Yes. But yeah, so posited. Yes, there are lots of people who believe that TikTok is a security threat, but that's my whole point, right? Is that it doesn't matter whether they're right or not. It doesn't matter whether TikTok is a security threat. It doesn't matter whether China has the ability to press some kind of button and turn TikTok into a propaganda machine or into some dystopian thing from Infinite Jest where everyone just gets glued to their phones and loses all productivity, which is literally a thesis that I have read where they're like, this is China's geopolitical strategy is to turn us into a nation of zombies who are glued to our TikTok and we lose all productivity. There is a bunch of crazy shit out there. But
the idiocracy thesis,
right?
I think.
The point here is that all these, the smart people in Congress and the morons in Congress have managed to come to the same conclusion, which is that they're worried about TikTok and that they don't want it to be owned by the Chinese. And they have a clear majority in Congress to pass a law to do something about it. Why aren't they going to do that? What's going to happen is that CFIUS is going to come out with some decision and there's going to be a long court case. Why are the politicians reduced to just shouting at a CEO rather than doing the thing that's effective, which is making laws?
Because we are a nation of laws, Felix, and you can't just go around banning stuff willy-nilly, as the Trump administration learned when it tried to ban TikTok during his reign. And it went to court, and the Trump administration was told, you can't just ban it. You have to see if there are other ways you can rein it in so it's less of a security threat. So that's what the Biden administration, and I recommend listening to What Next TBD on this, which came out Friday, which goes really deep on this. But so the Biden administration has been trying to do that, kind of build a case to show why they can't just rein in TikTok in other ways and they have to do an outright ban. And that's kind of why, I think. Also, I'll just say there is one lawmaker, one brave soul, Jamal Bowman from New York, who is a congressman from a neighboring district from where I live, who has come out and said, this is crazy. People need to calm down about this. And I have to say, I know that I'm supposed to be worried. I've had arguments with my Axios Markets co-writer about this. I know I'm supposed to be worried about the Chinese spying on me and on TikTok, but I'm not. And I think it is a panic. And a lot of the criticisms raised in Congress this week about TikTok could be raised about any social network. They're worried about the kids and their young brains, which, okay, right, ban a gun. But the same could be said for Facebook or Instagram or Snapchat. I mean, all the same concerns are there. And I think there is a parallel push now to maybe pass some privacy legislation or something along those lines that's more broader addressing those issues. But it kind of does seem a little bit like your typical panic over a foreign company without a whole lot of evidence about spying. The one example everyone points to, and Lizzie O'Leary on What Next talks to the reporter. In this case, the one example is that TikTok tried to get the data of some U.S. reporters to find out who was leaking to them. But that's something that's happened with U.S. companies, and it's not really it doesn't seem like a national security threat. I mean, I don't want companies spying using technology on reporters. But like Uber did that a few years ago. TikTok doing it isn't unprecedented, and it didn't seem like an example of the nation state of China doing something nefarious.
So I 100% agree. I think the China paranoia has gone completely batshit. I think the idea that the Chinese Communist Party can like insert spyware into TikTok that it can then use to exfiltrate personal data that it can then use for, you know, some weird info war against the United States that is like this weird vector of weakness that we're exporting. The whole thing is just sci-fi to me. And it is the thing that worries me about it is that it is completely unfalsifiable, right? Anyone can come up with any, you know, outlandish theory and say, well, it's a risk. We should be worried about this risk because it's a risk. And you can say, like, this is completely right, but it's a risk. Can you prove that it's impossible? It's like, no, you can't prove that it's impossible. But, like, can we just stay in the grounds of, like, things that we know are possible? But no, apparently we can't stay within the grounds of things that we know are possible. And we need to worry about things that we have no idea whether they're even possible or not. And as you say, Emily, like there's no evidence that the Chinese Communist Party has used TikTok at all. And, you know, so, and this whole concept of like, we need to be worried about a propaganda vector, you know, like seriously, we're not living in 1914 anymore. Let's just, so I'm with you and Jamal Bowman on this, but I am clearly in the minority. And, it does strike me that, you know, what the Trump administration tried to do was ban TikTok unilaterally just by like executive order. And that is clearly illegal. And the court said, go away. My point is that Congress can pass a law. We are a nation of laws, as you said. And Congress can pass a law saying, you know, Chinese companies are not allowed to own a social media network or something, right? Dress it up in all of the national security concerns that they like, and they're not going to. And this is going to wind up in the courts, and there isn't going to be a law that they can point to saying that TikTok has to be sold. And for that reason, there's a good chance that it won't be. And the thing that just confuses me is why are they reduced to shouting at a CEO on the telly when they actually have lawmaking power?
Well, I mean, normally a hearing like this is a precursor to potentially making laws around it. But also, we should mention that there's one other option that the TikTok CEO put on the table, which is what they're calling Project Texas, where all of the American data is stored and managed by Oracle in the U.S. And they're making an argument.
Well, that's not an option. That's the status quo. That is where we are at right now, and that is the thing that the American lawmakers seem to consider insufficient. Like Project Texas.
I think they're trying to implement Project Texas.
Like it is not fully implemented yet, but TikTok is implementing it, and they have said very clearly that this is what they are doing. You know, this isn't something that they're offering up as a possibility. Like, if you want us to do this, we can do this. They are already doing it. They are in the process of implementing it right now. It's not like, it's not an option. It is going to happen anyway, unless, you know, they're forced to just sell the whole thing.
Did you know there's some precedent that Grindr was owned by Chinese investors and was forced to be sold and went public last year?
CFIUS forced the deacquisition of Grindr, which is so much easier because it was like a company that was bought and then could be sold. Whereas TikTok is, you know, it's really part of ByteDance. You know, it's very hard just on a sort of technological level to see how, because the algorithm is a ByteDance algorithm, it's hard to see how TikTok could exist as a product without using this algorithm that is owned by a Chinese company.
What a mess. Plus, every story that talks about this says who would be big enough to even buy TikTok? You wouldn't want Meta or Facebook to buy it because then that would be antitrust. And like, who else would do it? Only the companies could do it or too big, blah, 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 blah. So I don't know how that would work. Do you?
Exactly. Well, I mean, you know, The obvious company would be Oracle, but like, yeah, does Oracle really want to own a social media network? Come on, that's not what it does.
That's a bad idea. Oracle owning TikTok, that seems incredibly uncool.
Exactly. Who wants that?
Like that?
No one wants that. No one wants Larry Ellison running TikTok.
Yeah.
I'll tell you one thing. Larry Ellison is much more likely to interfere in TikTok than, the Chinese Communist Party. It'll turn into... We've already seen what happens when a crazy Silicon Valley billionaire takes over a social network. We don't need another one. Come on. We've already got like Elon Musk and Mark Zuckerberg owning social networks. Let's not have a third, please.
I would pay to watch a Larry Ellison TikTok, though.
But which would be better? Elon Musk owning TikTok or the Chinese Communist Party having oversight over TikTok?
Oh my God, can you imagine if Elon Musk owned TikTok and Twitter? Oh God, that would be very, very, very bad. Come back, China, all is forgiven. Let's have a numbers round. Emily, do you have a number?
Yeah, my number is 9. That's 9%. That is the increase from 2019 to 22 in hourly wages for the bottom 10% in the United States. So that wages went up at the bottom by 9%. It was bigger than any other income category. This was a report from the Economic Policy Institute. They looked at census microdata, and this is adjusted for inflation. So it's a real raise, and it all sounds amazing. But then it means the 9% means that hourly wages are now up to $12.42, which is not a lot of money, but still notable. This is a percentage increase no one's ever seen before at the low end. And I thought it was really interesting. We all know that's tight labor market, blah, 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 low unemployment. But one thing that made this possible was that everyone got, at the low end of the scale, basically everyone got fired in COVID and laid off. And that sort of severing was a good thing, it turned out, for people at the bottom of the pay scale, because they were given the freedom, thanks to the fiscal support, to kind of find something better, which when you're, working all the time, you're not really looking so hard. So they call it, the EPI people are calling it severed monopsony, which I didn't write about because I didn't think anyone would care.
In my book, I call it, I have a chapter of my book, where I talk about shaking the Etch-a-Sketch, which is... There you
go. Yeah. That's much better.
That's which is a metaphor I actually stole from Dave Girard, who's this entrepreneur in California. But yeah, we just shook everything up and rebuilt it from a better foundation of more money. And it's absolutely astonishing to me how many people think that the pandemic increased inequality when in fact it decreased inequality.
I know. It's still pretty crap to be at the bottom 10%, but
yeah. No one's saying that like it's good to be poor, but it's better to be poor than it was. Elizabeth, what's your number?
My number is 159, and that's dollars. And this number comes from a story I was reading about an increase in pet ownership and higher costs for owning a pet. So for $159, you can buy an implant for your pet called Nudicles. And these implants help neuter-hesitant pet owners overcome the trauma of altering and allow their beloved pet to retain its natural look and self-esteem. So if you don't want to get your pet neutered, you can buy this specific implant that somehow does the trick, but allows your pet to keep its self-esteem.
You mean...
And by self-esteem, we mean testicles.
Yes, and it warrants owner's self-esteem, I suppose, but this is an expense that as a pet owner...
It's basically truck nuts for your cat.
Yes.
Oh my goodness. What will they think of next?
Jake Gyllenhaal bought them for his German Shepherd, apparently.
Oh yeah, because the German Shepherd, that's got to retain its nudicles. What am I... Shh. Go ahead. Do you have a number,
I love
Felix?
the fact that both of you are like really hesitant to say the word testicles.
This is Slate money.
We have Slate money succession. We're going to say a lot worse words than testicles. My number is 60.7 billion, which is a dollar amount. It's the number of dollars that UBS is taking as bad will in the acquisition of Credit Suisse. And this is a bad will number that is, I'm pretty sure, by some extraordinarily large margin, the largest amount of bad will that any M&A deal has ever had in the history of the world. Elizabeth, do you know what goodwill is in M&A?
It's a sort of value of I can't remember. I can't think of like a way to describe it. It's sort of no. I'm not going to try.
Okay. So in most M&A deals, what you have is a company which, let's say, it has assets of $3 billion, right? And then what you do is you get some acquirer coming along and saying, we want to buy your company. And they're like, how much are you going to pay? And they say, well, we'll pay you $4 billion. And so when they do that, because of the way that bookkeeping works, they lose $4 billion, which is the amount that they're paying for the asset, for the company. And then what they gain is $3 billion of actual assets. And then there's $1 billion that you need to account for somehow. And so the way they account for it is goodwill. Like they're saying, things like brand value or just like, we synergies, that kind of thing, right? They're like, we're going to pay an extra $1 billion of goodwill. It's going to sit on our balance sheet as like the extra value that this company has over and above its like actual asset value.
Yeah, I was searching for the word premium, and for some reason my perimenopausal brain just could not find it. But yeah.
So yeah, exactly. It's the premium that you're paying basically over and above the asset value of the asset you're acquiring.
No. So bad will is going the opposite direction.
So basically, UBS acquired Credit Suisse for $60 billion less than its asset value.
Wow.
And so they are getting $60 billion of, assets for free, which is kind of amazing.
I love that so much. It's like a good sale. You're like, these pants cost $100, but I only paid $50. And that's like a good thing.
Exactly. So yeah, well done, UBS. There's a nice little chunk of change for you, which should help smooth the transition to, merging with Credit Suisse. So I think that wraps it up for this week, guys. We have something very special happening on Monday, which is the very first episode of Slate Money Succession. Well, actually, like the 21st episode of Slate Money Succession. But the first for season 4, you have to watch Succession on Sunday, obviously, because it's coming back. And as ever, when Succession is back, Slate Money Succession is also back. And we're going to recap the first episode with Jim Stewart of the New York Times, who's amazing, who knows everything there is to know about Sumner Redstone, and is going to talk about how Sumner and Logan Roy are similar and different. That's all coming up on Monday. And then right now, if you're a Slate Plus member, we get to talk about Rupert Murdoch because he's getting married again. Obviously, this is very Logan Roy and Succession-ish. All that's happening on Slate Plus and Monday, Slate Money Succession. Thank you to Patrick Ford for producing. Thank you all for sending in your emails, slatemoney@slate.com. And we'll be back next week with more Slate Money.
Hey everybody, it's Tim Heidecker. You know me, Tim and Eric, Bridesmaids, and Fantastic Four. I'd like to personally invite you to listen to Office Hours Live with me and my co-hosts, DJ Doug Pound.
Hello.
And Vic Berger.
Howdy.
Every week we bring you laughs, fun, games, and lots of other surprises. It's live. We take your Zoom calls.
Music.
We love having fun. Excuse me?
Songs.
Vic said something.
Music.
Songs.
Music.
I like having fun. I like to laugh. I like to meet people who can make me laugh. Please subscribe now.